Hi, and welcome to my monthly Market Insights video. My name is Dan Timotich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. Opinions expressed in this video are mine, do not reflect the opinions of others. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, so the stock market is hitting all-time highs. Seems to be every day, and you're probably feeling pretty good about things. You should. Who doesn't like to see their retirement accounts grow? But at this point in the market cycle, I think there's reasons to be both bullish and bearish. Earnings are beating estimates. The bar is very low, very, very low. The U.S. economy continues to expand, but it's slowing. Trade tensions are not increasing, but nothing has really been agreed to either. All of these can be bullish or bearish depending on your interpretation, but this video will discuss risk management and why I think investors should focus on risk management in the coming months and years. Remember, if you're always swinging for the fences, you may hit a couple of home runs, but you're also going to strike out a lot. Okay, so one of the reasons to be cautious here is earnings. Earnings for the third quarter are in, and it looks like about 75% of companies have reported a positive earnings surprise from very low estimates. We do see earnings decline of about 2.5% this year, and it looks like it's going to be the first time that the index has reported 3 straight quarters of year-over-year declines since the fourth quarter of 2015. Analysts continue to bring down earnings estimates for the fourth quarter, but they are increasing their estimates for 2020. The problem is these analysts are often wrong, and as Yogi Berra once said, it's tough to make predictions, especially about the future. So let's see how analysts have done. Here we have a chart from our friends at Yardini Research. It's a little busy, but if you look at the right half of the chart, the green line, analysts began publishing their 2018 earnings back in 2016. At that time, they expected earnings to grow at about 12%, but by the time we got to 2018, these estimates were being raised, and earnings finally came in at almost 24%. These analysts were really wrong back then. Now, if we look at the black line for 2019 estimates, in 2017, analysts began reporting their expectations for 2019 to grow at about 10%. By the time this year started, analysts began to ratchet down those forecasts, and it now appears that earnings are only going to grow at about just under 1.5%. Again, these analysts were really, really wrong. Today, investors are hoping that analysts are going to be right about 2020, and it's driving the markets higher. I'm not saying that these earnings forecasts are irrelevant, but I do worry that too many people rely solely on these analysts to allocate their investments. So when you invest in companies, and therefore you should really be looking at what the companies are telling us. Here we have a chart from our FactSet that shows the company guidance from their earnings calls that were broken out by sector. These first four bars and sectors show companies that are in the industrials, materials, communication services, and consumer staples sectors. They have all issued negative guidance for the fourth quarter, and I think this is hardly a bullish environment. On the other side of the spectrum, only the utility sector had 100% of the companies provide positive guidance, and again, this is not a very bullish environment. Now, I realize that many of you don't look at specific sectors, so let's take a look at the entire S&P 500. Here you can see that only 28% of all companies have issued positive guidance and 72% have issued negative guidance. These numbers indicate to me that investors should be cautious going into year end as well as 2020, and that's why we're going to be talking about risk management this month. Now, I realize that when markets are moving up, most investors don't really want to worry about managing risk. After all, you feel good and your money's growing. You don't have much to really worry about. However, ignorance is bliss, and it's important to understand what risk management is really about. First of all, risk management is not market timing. It's the process of quantifying market risk in order to increase or decrease the amount of exposure you have to various risky assets. It tends to smooth out your investment returns because it allows you to participate during favorable market conditions and avoid potential pitfalls when things start to deteriorate and roll over. In general, the goal is to make your investment portfolio feel more like this and a lot less like this. Now, managing the ups and downs may not provide immediate gratification, but here we have the performance of the S&P 500 index in 2019, and as you can see, the market has done quite well. But we did hit some speed bumps in May and July. The point here is that if you reduced your risk in May, you would have only sacrificed a small part of the upside, and had the market have sold off a lot more from here or from here, you would have been much better off. However, investors do sometimes want to squeeze out every last cent of the upside, but if they're going to do that, they should also be prepared to feel all of the pain to the downside. It's important to remember, we can't predict if the market is going to stop falling at 5, 10, or 20%. The only thing we can control is how much we're exposed to when the selling begins. Protecting your gains here is a lot better than being forced to sell when things fall apart. Remember that old saying, it's not what you make, it's what you keep. Now, many investors think you need to always be invested to do well in the markets. I fundamentally disagree with that. Sometimes it's good to be invested, and sometimes it just makes better sense to protect what you have. As you get closer to retirement, you have to understand and ask yourself, can you really afford to be on a roller coaster that's going to potentially erase half of your nest egg? Some people can, but most people can't. Sometimes it's just as good to go out on those teacup rides, and we'll kind of give you a little bit of an example here. Here we see that a $100,000 investment in the S&P 500 on March 24th, 2000 would have grown to just over $236,000 by the end of 2018. Pretty good. You stayed on the roller coaster for all of the ups and downs, and you finished the ride with an additional $136,000 or so. That's great, but what if you decided to ride those teacups instead of the roller coaster? Here we have the same $100,000 investment invested on March 24th, 2000, but this time we're going to assume that we only get half of the upside and we only take half of the downside of the market. In the end, you're going to have just over $245,000. You would have actually made more money on the teacup ride than you would have on the roller coaster. But how can that be? The fact of the matter is, the less you lose, the less you have to make up. Here we have a chart from our friends at BlackRock. It shows how much you have to make up based on how much you lose. If your investment falls by 10%, you need the investment to increase by 11% to break even. But what if you lose 30%? 30% loss requires your investment to grow 43%. A 60% loss would require a 150% return just to get back to even. And by the way, the loss during the 2008 financial crisis was about 60% from top to bottom. And my point here is that managing risk may not show immediate benefits, but over time it provides a much better experience and smoother returns. So what do we do now that the markets continue to hit new highs? Well, if you paid attention to the last few slides, you manage the risk you're exposed to. Ignoring your risk exposure will cause you some pain at some point, and it's usually at the most inopportune time. You should be balancing your exposure, decrease your risky positions, and increase your exposure to less volatile investments. You can still get good returns without swinging for the fences. Look for alternatives. You don't always have to own stocks or bonds. There are other investments out there that could provide you with some good returns. And finally, don't just set it and forget it. Take some money off the table when markets are at the top of the range. Chances are you're going to have an opportunity to get back in when things get a little cheaper. But if you're just trying to squeeze out every last percentage point, that could really prove to be quite costly. Remember what I said at the beginning. If you are always trying to swing for the fences, you may hit a couple of home runs, but you're certainly going to strike out a lot. Thank you all for watching. I hope this video was helpful. And if you have any questions on anything in this video or just want more information, don't hesitate to call or email me. Thanks again, and I hope to see you again next month.